speaking here as the Financial Inclusion Advisor to the G-20 Financial Inclusion Experts Group, Access Through Innovation Subgroup Co-Chair. We are Australia and Brazil are co-chairing this Access Through Innovation. And the Australian co-chair, Paul Flanagan, from our Treasury, sends his greetings to all of you, and particularly thank you to KDI for inviting us to present here today. So thank you. The G20 finance ministers just met in Busan in Korea, and they recognized that the strong policy response to the global financial crisis by the G20, including Korea and Australia as well as other G20 leaders, was pivotal to restoring growth. And as part of that response to the crisis, the G20 has set up the Financial Inclusion Experts Group. And at Pittsburgh, as we were reminded this morning, they committed to improving access to financial services for poor people. And so they set up the Financial Inclusion Experts Group with a mandate to identify lessons learned on innovative approaches and to promote successful regulatory and policy approaches and elaborate standards or principles on financial access. So that's what our group has been doing. And as you can see, they're still draft, because even though they were welcomed by the finance ministers, we have to wait for the leaders to officially endorse them next week at the Leaders Summit in Toronto. So let me go through them. Now, why innovative? We've heard lots about MFIs in the last few minutes. Why focus? Why does the G20 focus on innovative? The answer is numbers matter. Of more than 2 billion, if you use different calculations, you can get close to 3 billion. It's a big number. Have no access to formal or semi-formal financial services. But there are at least 1 billion now, and as Mr. Yannick pointed out this morning, in the next 2 years, 1.7 billion people with a mobile phone. And there have been examples of financial services provided using such types of technology that have expanded very rapidly. So, if we care about increasing access to financial services, we've got to look at ways to reach big numbers. So, where are we drafting these principles from? If this really is innovation, where does it come from? Is it out of our heads? Thankfully, no. There is a wealth of experience in G20 and non-G20 countries. Our colleagues at CGAP have done detailed diagnostic work in 11 of the leading countries, including Philippines, Kenya, Brazil, Colombia, and I could keep going. They're on CGAP's website if you want to know the detailed policy and regulatory diagnostics. The Alliance for Financial Inclusion, we'll be hearing from them this afternoon, have done a survey of policymakers in over 50 countries. And we, as the G20, have gone to through extensive consultations with stakeholders, including the G24, the leading central bankers, the Development Assistance Committee, and the standard setting bodies that are critical here. I note here the Financial Action Task Force. Sorry, is it still buzzing? It's okay. The Financial Action Task Force, but the other standard setters include the Basel Committee, which we all know is critical, the CPSS, the International Association of Deposit Insurers, FSB, all the leading standard setters we have worked with. So this is not a G20 only. This is extensive consultation where these principles have come from. So there are 9 of them. So, my dear Chairman, we will keep to time. First one, cultivate a broad-based government commitment to financial inclusion to help alleviate poverty. Just thinking about it, many of you are academics, many of you come from government. It makes sense. You've got to start with some kind of leadership, right? If you're going to make a difference, if you're going to fundamentally change the way that the financial system works, so that it includes the more than 80% who are currently excluded in many developing economies, then you've got to have strong commitment to expanding financial inclusion at the highest level. In the report that the subgroup has written, which will come out, it'll be on the G20 website hopefully next week, we use the cases of Mexico and Pakistan, but every single country that has taken the initiative has shown leadership in some capacity. It just makes sense. Thinking about it, for those of you who are experienced in microfinance, you know that savings are critically important, but not just savings. Access to credit, access to insurance, and access to payments, internal domestic payments as well as international payments, are all services that are important for all of us, whether you're rich or poor. Access to a range of financial services is critical. And and if you're going to be able to expand the range of different services, then you've got to have that, a regulatory framework that will allow that. Many of you know the case of Kenya, where the payment services, domestic payment services, have been established using mobile phones. I think it's a great number. Starting in early 2007 till the end of 2009, 8 million subscribers use domestic payment services. In 3 years, 8 million people. That's a big number. And so that's the type of example of a payment service. It's not microcredit, it's a payment service that there's huge demand for. But the Kenyans are not satisfied with that. They're now looking at agent banking using the experience of Brazil. They're looking at, do branches? Have we got a right framework for expanding services using the current branches? Maybe we need to think innovatively about branches. They're also looking at microinsurance. I've mentioned India here. The Insurance Regulatory Commission in India has said, well, wait, if insurance is critical for helping poor people reduce risk, why not think about relationships between NGOs and insurers so that we can expand access that way? And so they've permitted that in India. And there are many examples of using a diverse of governments looking at ways to create a policy and regulatory environment that will enable expansion of a diverse range of services. Although, of course, I underline my colleague's point that it's not the government providing the services, but providing the regulatory environment for the private sector. Now, if you're a subgroup focusing on innovation, of course you're going to have a principle on innovation, right? And so it's obvious, but it needs to be stated, because often those of us who work in microfinance only work from what we know. And we often have to be reminded that there are many innovations out there, and we need to think beyond small microfinance or even large microfinance institutions. Innovation is going to be the future. I think that was a prediction that you had, Eric. I fully support that. So harnessing the capacity of technology to reduce costs has made it economically viable for financial service providers to reach significantly greater numbers. A colleague in the region, the Philippines, they have shown great leadership. Their government is very committed to financial inclusion, and their central bank has been looking at how innovation can promote expansion of financial services. And actually they have allowed 3 different types of innovation to go ahead in terms of mobile phone banking, for example. They have a bank-based approach that they're looking at. I see somebody nodding, so that's good. Thank you, sir. They have a non-bank-based approach, and they're working with the rural bankers to look at how the rural bankers can use mobile money. So they are not saying there's only one way. They're saying, let's pilot this and see how we can use innovation to reach more people. Because they have a huge challenge with all their islands, as you know, and a very diversified population. And our colleagues in Brazil, who are co-chairing with us, probably have the biggest geographic challenge of many of us in terms of the far distributed population. And they have their innovation in terms of using agents we'll talk about in a minute, but there are many different ways of using innovation to increase access. As I think we must have been on the same mindset, Mr. Yannick, this morning, consumer protection is critical. And the G20 leaders have said this: to encourage a comprehensive approach to consumer protection is essential if you're going to expand access. You can't expand access without looking at consumer protection. I think this came up in Eric's presentation too. The Mexicans have probably done the most in this. They have, we've got a long list, I won't go through them, but we can read the report next week. But they have, if they have agents, the providers are liable for their delivery of services. They're required to train their agents. They're required to display their fees, provide redress mechanisms, educate consumers. They have a law on transparency of financial services, and they've strengthened the powers of their Financial Consumer Protection Agency. And that's just the beginning. So they see it as absolutely critical, and I think it related to the responsible finance point that Eric made as well. So there are other examples, but taking consumer protection very seriously is essential if you're going to be using innovation to expand access. Financial literacy. I'm sure many of us here have looked at statements for mortgages or car loans or any type of credit card loan, and the small print is quite challenging. And we're all educated. For those people who don't have the benefit of that education, it's challenging to understand what type of loan product they've got if it's provided by a mobile service provider, for example. So financial literacy is key. And Ghana is one of the first countries in Africa to have a national literacy campaign. They realize that if they're going to expand access, having everybody have a basic financial literacy is a sine qua non. It's essential. You've got to have it. And so they have started together, the government together with the microfinance providers, to look at that. South Africa too. These are just a few of the examples. And if anyone wants to know more, I'm happy to explain more. But as a principle, it's a self-evident one. Now, for those of you who come from government departments, I'm sure you know that it's very frustrating when you discover that another government department has been doing something that relates to you and they never spoke to you. I see some people laughing. So we've all been through that, right? I work for AusAID, I know the feeling. So when you're looking at innovation in financial services, they typically cross multiple distinct regulatory domains and public bodies. They involve the Banking Commission, they involve the Central Bank, they involve the telecommunication authorities, the tax authorities, the Ministry of Finance, obviously sometimes the Social Ministry too, and that's for starters. So unless you have the leadership, as we said, to start with, together with the cooperation, you will never be able to really advance on the innovation front. We use a Colombia example here, where the Banca de las Oportunidades has had to work with the tax authorities to reduce the taxes between banks and agents. There are examples in Pakistan where they've had to work with the tax agents similarly. So who would have imagined you've got to deal with the tax people when you're dealing with financial services? But it's critical if you want to keep costs low and use innovation to expand access. So unless you have cooperation, you're going to have a lot of hurdles to expanding access. Getting the right data, as mentioned earlier, is critical. And unless you understand what is happening on innovation, you won't be able to make suitable policy or regulation. And so we've called it a test and learn approach of balancing regulations that are acceptable to regulator and service provider. This is new territory. Regulating before the market has been incredibly problematic. So you have to work with the market. I think the Philippines use the term of they will regulate with the market, not in front of it. And they have had, in the Philippines, they have had several years of working with their pilots, and only now are they working on e-money regulation. In Kenya, there was no regulation covering mobile phone banking at the beginning of 2007. But the central bank said, this has possibilities. This is consistent with what we want to do in Kenya. So what we'll do is we'll let you go ahead, but you have to provide a detailed audit trail so that we can track what's going on, we can learn from it, and you have to be compliant with the draft AML, anti-money laundering law, as well as when the national payment system gets organized, you have to be compliant with that. Because they knew they couldn't do everything at once, so they took a test and learn approach. And the central bank has been working closely with the providers in that case, and it has been able to support the innovative expansion of financial services by using this principle. Proportionality is a term that regulators like. Proportional to risk. Risk management is the business of regulators. And so, if there's not a big risk, then you don't need a lot of regulation. That makes sense. But people often don't think about it when it comes to low-value transactions and small transactions. You don't need the same amount of regulation. So, for example, in the Brazilian case, they have had agents for over 10 years and have been supervising agents. And it's interesting to note that in 2003, all supervised banking institutions were allowed to have agents. And the bank had to have full access to the agency agreement and transaction. And the central bank had to authorize every single agent. But they said, wait a minute, is this proportional to the risk? These don't provide any systemic risk to the financial system, and they do not provide any institutional risk that the banks don't know themselves. It's their business to manage their own risk, after all, they're commercial banks. So in 2008, they said, we don't need to authorize all your agents. You manage that risk. Just tell us. Register them, but we don't need to know. We don't need to authorize it. We do need to know. And so that was their example of proportionality in terms of regulating agents. So this principle has been used effectively. As they've learned, they discovered that this is what makes sense. And of course, the banks have been able to expand their agents because it's not taken so much time to get through all the authorization. Now, in the ninth principle, there are 4 sub-clauses that very specifically relate to the regulatory framework. And the first one is an appropriate, flexible, risk-based anti-money laundering and combating the financing of terrorism regime, AML-CFT. Now, this is managed by the Financial Action Task Force. And these guys are the police of the financial system. They want to make sure that there's no possibility for money laundering or corruption in the financial system. and that is entirely appropriate. And many regulators are scared. They kind of over-regulate because they want to make sure they completely comply. But Mr. Paul Vlaanderen, who is the president of FATF, has said there's complementarity. We would much rather people be in the financial system than out of it. And so, for example, in South Africa, that had very strict anti-money laundering rules. Everybody had to have an identity document and had to have their residence. You've been watching the World Cup. You see what the residences are like in Soweto. Do you think there's an address for all of those? Of course not. But each one of those people needs access to financial services. And so what the South Africans did, they said, well, to comply with anti-money laundering requirements, we will not require a specific evidence of an address as long as we know who that person is. So the specific terminology is, they issued an exemption eliminating the need to obtain and verify address details, subject to balance and transaction limits. So that people who locally knew that person, they didn't have to have all the official documentation in order to be able to open a Mzansi account, which is a basic account, a basic banking account. And more than 6 million such accounts have been opened. So they were still compliant. And in fact, in 2008, they had a FATF peer review, and they were still compliant, so that they were able to have mutually beneficial anti-money laundering regulations and financial access ones. Yes, I am. And so therefore, this is my last slide. The use of agents, we've talked a lot about with Brazil already. I don't need to go into the details on that. And a clear regulatory regime for electronically stored value. We talked about the Philippines case, and also the Indonesians have taken the same test and learn approach to electronic money. And the long-term goal of interoperability and interconnection, which means banks being able to use each other's ATMs and that kind of thing. So, the Toronto Leaders Summit, G-20 Leaders Summit, will happen next week. And assuming there's no major financial crisis in the meantime, that these principles will be officially welcomed and endorsed. And then we'll be working on an action plan to promote these principles, and specifically looking towards the Seoul Leaders Summit. As we heard this morning, the Seoul Leaders Summit will be looking at financial inclusion, innovation, but other aspects more broadly, because it's such a critical time in the global financial economy, and we need to look at how we can expand.